Hello. Today I'm going to talk about dollar cost averaging. Not the Jackrabbit module, but I will be using the Jackrabbit module. No, today I'm talking about the bigger picture. Dollar cost averaging as an opportunistic way to increasing your position size and then selling at a perfect opportunity. And I'm going to use a very simple principle and technique to demonstrate this process. So let's get into it. I've got the S&P 500 on the chart. And we're going to start with a simple moving average. I'm using the 1 hour and cross comparative of 1 day. I only want to see a signal if the 1 hour and the 1 day both show the same pattern. I want to be specific and strategic in my accumulations. And in this context, accumulation is simply adding to my current position size. But I don't want just a reoccurring purchase. I want to add to it when the number of shares per price is more advantageous. So I only want to add to it when I have a clear downward pattern. So let's see how we achieve that. And I'm going to hide the moving averages for now so we can actually see and focus on the opportunistic purchases that take place. And let's go back here to a complete cycle. Okay, here we go. I sold off the old cycle and I got into a new cycle. Now, the thing to bear in mind, and let me zoom this in a little bit, because we want to focus on some very key and critical aspects. And this is what makes dollar cost averaging different than a reoccurring purchase. Each point I purchase, I explicitly want my next purchase to be lower than my previous purchase. I want a clear and definitive advantage in my price action. This is what dollar cost averaging in general is about. Lowering the price each and every time per each purchase. It's critical that it goes down because when you're dealing with a stock that has dividends, you are paid dividends based upon the number of shares. So as the price drops, you can purchase more shares with the same amount of money. So this is a critical point and a difference between reoccurring averages or reoccurring purchases versus dollar cost averaging. Purchasing here is going to give you more shares than purchasing up here. More shares equals more dividends. That is an important distinction of a proper dollar cost averaging technique, simply versus reoccurring purchases. If you purchase every month or every week or every day, you're not going to get a true dollar cost averaging. You're not averaging your price down. Now let's take a look at this in a more strategic approach. So we've made 3 purchases in this trade cycle. The price started climbing. Now, if you were reoccurring your purchases, you would be buying all along the way, raising your average as it progressed. When you raise your average, you dilute your take profit. So here we go. As you can see, it's still above the average, the blue line. And in here, I made a sale. This sale is a 20% profit of what I've purchased. This is true dollar cost averaging, maximizing the leverage of what you are purchasing while waiting for a specific opportunity. Now you can set your opportunity to 50%, 75%, or even 100% of your initial purchase. Those are all up to you to decide appropriate to your risk assessment and financial situation. Here I simply chose 20%. So when my position increases by 20%, I've made a profit and I want to claim that profit. You don't have to. You can simply let this continue until some point that you manually decide to take some of your position out. But I wanted to take and get into this in such a way that I could use automation. For example, this run, we've already made 4 strategic purchases, and each purchase is lower than the last. My average is lower. So my average profit, 20%. My last profit, 20%. So 6 trade cycles. Let's take the average of 5 positions per trade cycle, or 30 positions total. Not bad. Of course, you see it's taken 4,000 days. So this isn't a short-term process. And during this duration, you're earning dividends along the way. That's critical and important as a long-term investing process, with or without actually taking any profits off the table at any given moment. So this long-term scope is designed to be very simple. I am using Jackrabbit in such a way that I am looking for opportunity. And that opportunity is a critical standpoint. So as you can see, very simple settings. Now I'm shooting for 25%, but overall my average is 20%. That's acceptable. That fits a very well-rounded approach. Remember, you're going to be dealing with slippage to some degree. And slippage can always be a dangerous thing. But at this level of trading, it's not going to hurt you. You're also dealing with fees and commissions. So this is a good day. For the intent of what this is trying to achieve, it is spectacular. So an opportunistic approach that just works. And it really works on just about anything. Here is another asset. Now you'll notice 20% is quite steep. It doesn't achieve it easily, but it does achieve quite a few accumulations along the way. And of course, it does achieve dividends. That's important to get those dividends along the way. So while you're holding and accumulating, you're reinvesting your dividends, and that's going to help this position grow even more. And some assets simply haven't had enough time at all to even go through one trade cycle if you're into this kind of an asset. Now, if you did simply reoccurring purchases, you would have more positions. But more positions are not necessarily going to be better prices. The intent of this situation is specifically to maximize the leverage of price action in a true and pure dollar cost averaging approach. And here, with this particular asset, 3 trade cycles for 4,000 days, and you're making dividends once a month. So this is going to accumulate quite a bit over the course of its history. And using this opportunistic approach means you're going to easily be able to build a portfolio that is sustainable, defensive, and at the same time is able to weather unusual circumstances. So unlike a reoccurring purchase where you just get whatever price that comes in, here you're looking specifically for how to leverage your money in a meaningful way. A true dollar cost averaging approach. And this is showing stocks, but it works just the same in cryptocurrencies. And let's actually take a look at Bitcoin. And yes, you can earn 20% on Bitcoin too. 890 days, 11 trade cycles, 21% average profit. So if you have the portfolio and the budget to sustain this, you have a significantly good advantage. Now, if you want a shorter time frame, dollar cost averaging does well there too. You would just need to make changes appropriate to your risk and your budget. Because as you can see, a 20% profit is difficult. It's not up until the 20 to 30 minute range that you start seeing 20% in one single point. So let's bring this down to, say, a modest 5%. Here you go. 3 trade cycles, 5%, and moderate accumulations. Respectable and reasonable, and only 250 days. A little over half a year. Now, if you go down in time scale, you'll see that change. But it's still well worth the defensive approach. And that's really what this is about. Defensiveness. This kind of a technique is not rapid. It's strategic based upon market. And market based upon your own abilities. Now this is also very nice because it's tunable. With a little bit of work, you can make this more aggressive. But the intent of this is long-term investing, long-term profitability through proper dollar cost averaging, through proper price depreciation. So let's zoom in and look at these three. Okay. And as you can see, here is this particular candle and this particular candle. Price going downwards. So it really just depends on what you are looking for and how you want to trade. For example, let's go here and take a look at a coin that is quite interesting. A large number of trade cycles, low exposure, and for a long-term approach, this is not bad. Very good averaging technique. Very good cost efficiency with very minimal drawdown. Now, again, this is not reoccurring. This is dollar cost averaging and opportunistic selling. Here, minimum 5%. Now, you could go longer term if you really wanted to increase your abilities. And I've talked about this before. The higher the percentage, the more accumulation. You can easily achieve higher percentages, but you're going to wait longer and be more exposed to the market. And here we are. Now, you always know when you're starting to stretch the market too far. When your percentages don't match here what you've requested here. So the average take profit is 13%. I requested 15%. So that tells me that I'm pushing the physical threshold of what this market will allow within a reasonable amount of time. But 10% is quite possible. And the accumulations are still very low. So let's look at the settings. The momentum itself is a very simple approach. As I said, I'm using confirmation bias or two indicators. The first one at the current time frame, using a split channel high-low. I'm using just a simple moving average. Nothing spectacular here. And I've got a length of 273. A little longer than normal because I'm looking at a longer term trend. Now I want the signals inverted because I only want to purchase when the market is moving upward. I want the opportunity to be in my favor. Now that doesn't seem intuitive at first. You're only purchasing when the market is moving upward, but you're only allowing accumulation when the market is moving downward. That sounds conflicting. But it's not, and I'll show why in just a minute. Now the 1 day time frame is my confirmation. Again, a high-low split channel. And again, a simple moving average. Now again, in one day, I'm looking at the last 273 days. Long term, almost a year. And again, I am inverting my signal. I only want to make a purchase when the market is trending upward. Now let's get into why. Why do I want the market to trend upward? And I will show you with these examples. See, when the market is trending upward and they match both the current time frame and the one-day time frame, you're not going to be following the market down. You're only going to be making a very limited number of purchases. So that when you actually see that in your dollar cost averaging, it's not going to purchase anything above your average. But let's go back here. Let's find when it started purchasing. Okay, it started purchasing and it made 2 purchases. Now in both cases, we're only purchasing when the market is going upwards. So we purchased here. Okay, the market's still going upwards, but the price is depreciating. The price action is going downwards. So this means that the upward trend in the market is losing momentum. It's losing steam. And it could be a change of direction where the market may drop even more. And let's see if that's true for the long term. And it did. We had a huge drop right here because of that loss of momentum. So this kind of a technique helps you see where the market is going and helps you prepare for a level that allows you to increase your holdings in a rational and reasonable approach. Now here, it wanted to make a purchase, but because the price was above the average, it didn't. That's critical, because had it done that, it might have missed its take profit boundary. So by not purchasing above the average, by not just blindly accumulating in a simple reoccurring purchase, it strategically picked a nice little profit to cash out. Now let's see if we can find another example. In fact, let's go outward and let's take a look at this rather brutal bear run that we've been in through November. And as you can see, the whole market is just trending downward aggressively. Now there are a few opportunities using this technique where there was an entry, price action was stable, a purchase was made lower than the first, but then right here, opportunity, it made a sale. Now let's go into the 1 hour. So here we see the bigger, let's look at the bigger market. All of this downtrend. You can see pricing just literally dropping. $18 down to $6. A 65 to 66% drop in price. And notice it didn't make any purchases but one. One purchase right here when opportunity demonstrated the perfect entry. This is dollar cost averaging at its best. Strictly opportunistic. And as you can see, it's a cautious and simple waiter. It doesn't waste your money. It looks for the best places to get in to the market, the best places to maximize your profitability. Now with cryptocurrency, dollar cost averaging in this approach is more appropriate because you don't have dividends. Cryptocurrency is non-appreciative. You don't gain anything from holding it. If it goes up, great, but the likelihood of it going down is just as significant. So if you don't claim your profits when you have an opportunity, you lose those profits by this trend. Now, you don't lose them physically because you have to wait for the market to recover. But why wait for the market to recover when you could have gotten out strategically right here? Skipped all of this. Cashed out, skipped all of this, and completely waited until the market plateaued again to make another strategic entry into it. Dollar cost averaging is about opportunity. That opportunity is about making the best use of your money. Reoccurring purchases don't do that. As you can see, it's a simple, quiet process of waiting. It's not exciting. It's not going to make you money. But in a bull market, it does represent some very nice opportunities. In a bear market, it's just a quiet and patient strategic waiter. So here we go. Nice little pickup. The bull market came in. We had the first market turbulence. Picked up again. And then we had the beginning of some very deep market down runs. So here you have it. All of this market down run. And yet it still was very strategic. Now let's keep going. Okay, it picks up a little bit in August. Picks up in November, but we're still not at the average. This is our average. November 15th, and the bear market hits. And slam. One big, giant roller coaster straight to the bottom. But not to our low point. We're not going to make a purchase until the price goes below the previous purchase. Price climbs back up a little. Then it drops back down. But right here, it's above the lowest price, so no purchase. Finally, we get an opportunity to purchase, an opportunity to increase our position strategically and sanely. And now we just keep going. And now another opportunity. So as you can see, opportunities with this kind of strategy are critical. But you can see they're not wasted. Look at your numbers. These numbers are important. These numbers tell a very clear story. If you have a very limited budget and you want to maximize it, this is the approach to go. This demonstrates a clear, concise, and purposeful approach to long-term market uncertainty. The true meaning of a real dollar cost averaging approach. Now, dollar cost averaging in general can be used in a wide range of circumstances, and I prefer it in my daily trading. But a dollar cost averaging strategy, emphasis on portfolio mitigation for risks, on budget diversification. This is how you approach it. Long-term market opportunities. Hopefully I've been able to explain that in terms of just exactly how to use a dollar cost averaging technique as a strategic foothold on the market, which is different than recurring purchases, and it is also different than a dollar cost averaging module. It may seem like the same, and in some contexts, they are the same, meaning you're averaging pricing down. But the strategy is long-term thinking. The strategy is about value and growth, whether it's dividends, appreciability, or just looking at opportunity. So hopefully you found this helpful to being able to see when and where to take those opportunities and how to maximize them on a bigger picture. Here's a good example. This one took almost 3 years, 21 trades, average is 11%. Now, if you have a fairly significant budget and you want to be cautious with it, say you have $25,000 and you want, say, $1,000 per position. Your worst case with this recipe is only going to be a $6,000 exposure. 10% of $6,000 is a $600 profit every time this happens. 21 times 6,000, or times 600, excuse me. Let's just go with 20. That is $12,000, if I did my math right. That's a pretty significant increase in 3 years for a simple strategy. Long-term trading is critical in terms of thinking if you have high adversity to the volatility of the market, no matter what market you're trading. This is the distinct advantage that this kind of an overall technique gives you. It gives you peace of mind that a systematic and a cautious and meticulous approach without emotions is going to win over time. So, leave any questions you might have in the comments. Let me know what you think. Let me know if your trading incorporates long-term thinking as well as short-term thinking. Like, subscribe, and until next time,